You have $1,000 sitting in your business account. You also have credit card debt at 21% interest. And you have heard you should be investing because the stock market averages 10% per year. So what do you do with the money? Pay down the debt or invest it? For most people, the math is straightforward. For freelancers, it is anything but. Your income is variable, your tax situation is more expensive, and one bad month without cash reserves can undo years of progress. This video breaks down the actual math of paying off debt versus investing when you are self-employed, and gives you a decision framework that accounts for everything traditional advice ignores about freelance life. Welcome to the Freelancers Wealth Blueprint. We help freelancers and self-employed professionals master their money, reduce their taxes, and build real wealth. If that sounds like what you need, subscribe and hit the bell so you do not miss a single video. Let us start with the numbers everyone quotes, and then show you why they are incomplete for freelancers. The average credit card interest rate right now is roughly 21%. The S&P 500 has historically returned about 10% per year on average. So on the surface, the math is simple. 21% cost versus 10% gain. Pay off the debt first. For credit card debt, that is almost always the right call regardless of your employment status. But what about lower interest debt? Personal loans average around 12%. Student loans might sit at 5 to 7%. A business line of credit could be 8 to 10%. This is where the decision gets interesting, and where freelancer-specific factors change the equation. Here is the first factor most advice ignores. Your effective tax rate as a freelancer is higher than a W-2 employee earning the same income. On top of regular income tax, you pay self-employment tax of 15.3% on your net earnings. Yes, you can deduct half of that on your 1040, but the net effect is still significant. If you are in the 22% federal income tax bracket and you add in the self-employment tax impact, your effective marginal rate on the next dollar earned could be 35% or higher. That matters because investment returns are taxed. If you earn 10% in the stock market and pay taxes on the gains, your after-tax return drops. In a taxable brokerage account, your real return might be closer to 7 or 8% after accounting for capital gains taxes. Meanwhile, paying off a 12% loan gives you a guaranteed 12% return. No tax on that. No market risk. No volatility. Here is the second factor: variable income. A W-2 employee gets paid every 2 weeks regardless of market conditions. You do not. Half of all freelancers have experienced late or missed payments from clients. A single dry month can force you to take on new debt just to cover expenses, which completely negates whatever gains you made by investing instead of paying down what you owed. This is why the emergency fund is not just step one. It is the prerequisite to even having this conversation. Financial advisors recommend W-2 employees hold 3 to 6 months of expenses in cash. For freelancers, the recommendation is 6 to 12 months. If you do not have at least 6 months of bare-bones living expenses in a high-yield savings account, earning 4 to 5% right now, the answer is clear. Build that fund before aggressively paying debt or investing. That cash buffer is what keeps you from going backwards. Now, let us build the actual decision framework. Step 1. Eliminate high-interest debt first. Anything above 10% interest, pay it off as aggressively as possible. Credit cards at 21%. Personal loans at 12 to 15%. These are guaranteed returns that no investment can reliably beat on an after-tax basis. Put every spare dollar toward the highest rate balance first, while making minimums on everything else. The avalanche method. The math always favors it. Step 2. Fund your emergency reserve. Once high-interest debt is gone, build or replenish your emergency fund to at least 6 months of expenses. Park it in a high-yield savings account. Do not invest this money. Its job is not to grow. Its job is to keep you from borrowing at 21% the next time a client pays late or a contract falls through. Step 3. Capture free money. If you have a solo 401k or SEP IRA, contributing to those accounts gives you an immediate tax deduction. A freelancer in the 22% bracket who puts $5,000 into a SEP IRA saves roughly $1,100 in federal income tax alone, plus reduces their self-employment tax base. That is an instant guaranteed return before the money even grows. If you have any employer match equivalent through an S-Corp setup, capture every dollar of it. Step 4. Now, you do the math on moderate interest debt versus investing. If you have a student loan at 5% or a business loan at 7%, compare that rate to your expected after-tax investment return. The stock market averages 10% before taxes. After taxes in a taxable account, call it 7 to 8%. A 7% loan costs you 7% guaranteed. A 7 to 8% expected return is not guaranteed and comes with years where you lose 20% or more. For freelancers, whose income already carries significant volatility, adding investment volatility on top of debt obligations creates compounding risk. When your income dips and your portfolio drops at the same time, the psychological and financial pressure is enormous. Here is my recommendation for moderate interest debt. Split the difference. Put 60% of your available cash toward debt payoff and 40% into tax-advantaged retirement accounts. You reduce your debt, lower your tax bill, and start building long-term wealth simultaneously. As the debt shrinks, shift the ratio. Once the debt is gone, redirect everything into investing. Let me put real numbers on this. Say you are a freelancer earning $75,000 net after business expenses. After self-employment tax of roughly $10,597 and federal income tax, your take-home might be around $52,000. You have $8,000 in credit card debt at 21%, $15,000 in student loans at 6%, and $2,000 in your emergency fund. Your monthly expenses are $4,000. Here is the priority order. First, build the emergency fund from $2,000 to $24,000. That is 6 months at $4,000. You can do this gradually while making minimum payments on all debt. Second, attack the credit card debt. Pay off that $8,000 as fast as possible. The interest alone costs you $1,680 per year. Third, start splitting between the student loans and a SEP IRA. Every dollar into the SEP IRA saves you roughly 30 cents in taxes. The student loan at 6% is low enough that the tax savings from retirement contributions may actually beat the interest cost. The core principle is this. For freelancers, financial stability comes before financial optimization. A W-2 employee can afford to carry moderate debt while investing because their income is predictable. Your income is not. Build the floor first, then build the ceiling. Subscribe for more strategies designed specifically for the self-employed. See you in the next one. This content is for educational purposes only and does not constitute tax advice. Consult a qualified tax professional for guidance specific to your situation.